Good afternoon, everybody, and welcome to the April market update featuring the expertise of Mike Ott. Our distinguished speaker, Mike Ott, brings a wealth of experience to the table with a background as former public school teacher and an impressive double-digit tenure in the mortgage industry. Mike has earned a stellar reputation. His unique educational approach and unwavering commitment to excellence have endeared him to both clients and agents alike. Mike's profound understanding of the intricate nuances of the market, coupled with his unparalleled attention to detail, make this market update an indispensable resource for agents seeking to stay ahead of the curve. Plus, I love the fact that he waits to do it until after reporting comes out. So you guys aren't getting last month's information. You're getting this month's information that just is happening. And that's important because, as we all know, things are happening rapidly these days. As a senior home loan consultant at First Heritage Mortgage, Mike is well versed in the intricacies of the industry. Additionally, his status as a highly regarded and sought after trainer with us further underscores his expertise. So please join me in extending a warm welcome to our presenter today, the one and only Mike Ott. And also, this recording will be at cindybishopworldwide.com to upcoming events, and then go down to the right, say to meet our instructors, and then you'll find Mike's picture, click on it, and it'll be on his instructor page, updated later today after I render the video. Take it away, Mike.
Thank you, Cindy. Good afternoon, everybody. All right, time for our May monthly market update. And we start with our rate ranges, where we usually look at the loan programs out there and see kind of where rates have been trending. I'll put a note there at the top, tariffs and a wait and see stance from the Fed. They've caused rates to bump up a little bit here. We'll look at the candlestick chart here in a second. But in our loan categories, our conventional conforming, remember that's for loan amounts $806,500 and below. We're about 6 7/8 to 7 3/8. When we go above that conforming loan limit, we're talking about high balance or jumbo financing, and those are always about 0.5% higher. We have 7 1/8 to 7 5/8 in the jumbo world. Govy programs always a little bit lower. VA loan rates at 6.5 to 7. FHA and USDA rural housing trend together 6 3/8 to 6 7/8. MortgageNewsDaily.com is a great place where you guys can kind of keep an eye on the national averages for the different rate programs. They do a really good job of keeping that updated. And a lot of what's behind that is they're tracking the interest rates that are locked on the particular programs. And the caveat there is that there's probably in that rate that they publish anywhere between half a discount point in fee up to 1.5 in discount point fee, potentially associated with their average rate. So that's kind of indicative. Some say normal or customary. That most home buyers right now getting a mortgage, most of them are probably paying around a discount point fair rate, and that is then in turn what we kind of dub as here's the market rate, or this is where the market is. But think of these as kind of the market range. All right, candlesticks, mortgage-backed securities. Boo. Ugh. We had a nice little ride up the latter part of April into May. And for those of you that are new and haven't seen a chart like this before, green and up trend is good. Now, again, this chart and this data runs inverse to rate. So when you see this chart climbing and a lot of green like we did towards the end of April, well, that was good for interest rates, right? Because the inverse is happening. If this chart goes up, rates to the consumers go down. But as you can see, we are been really since the beginning of May. A lot of this data that came out that we'll take a look at here as far as market and economic news goes didn't really help. And we've obviously got the tariff stuff that's stealing most of the headlines, and most recently the US-China tariff delay. Highlighted that on the chart. And really the main reason for that, that's a big kind of down red day there. We were locking ahead of that last Friday. I got a lot of my active clients that are closing 15 to 30 days. We got them locked in last Friday. Because we anticipated that if there was any good to come out of the US-China talks over the weekend, we felt like, mortgage economists and economists in general felt like the stock market would like that more than the bond market. And if the stock market likes it and rallies, that typically means money is leaving bonds, which is where mortgage rates and mortgage bonds are. So good call by the experts to advise us to get our clients locked in ahead of that, because this week, the 3 days, as you can see, we're trending downwards on this chart. In fact, we are actually right now, this was a snip of the chart, probably around 11:30. We're dipping even lower on that red candlestick at the moment, and another lock alert was just issued. So not great movement for mortgage-backed securities in the here and now. That also coincides with, if you keep an eye on the 10-year Treasury note, you'll see that level is above 450 right now. And that's kind of been a lid that we were hoping would stay on. So we just kind of have to see how this stuff plays out. It's going to yo-yo. Yeah, this stuff is never in a straight line. All right, so since last month, slew of economic data. We go back to the end of April, which gave us the personal consumption expenditures PCE inflation data report for the month of March. It was flat month over month, decreased 0.4 to 2.3 year over year, right? And that's, again, where's the Fed want to see us? They want to see us at 2%. They want to see us at 2% on the core, which the core month over month is also flat, softer than the estimates. It came in at a 0.1% gain, and it remained at 2.6 year over year, and that was in line with expectations. So while it was good news that it met expectations, it didn't beat the expectations. Therefore, we really didn't see, any significant help in terms of giving interest rates or giving mortgage-backed securities a boost and having rates to the consumers come down. The April ADP employment report came out at the end of April as well. That showed an increase in only 62,000 jobs when the market was expecting 115. And the previous month's figure was revised lower from 155,000 to 147,000. Those are in green. If you keep with the charts, right, up in green is good. That's helpful bond. That's bond friendly news, as we call it. So was the February JOLTS job opening report. So it showed the job openings decreased and revised from 7.76 million to 7.56 million. That was less than the 7.63 that was expected. Now the BLS, which is kind of been our thorn in the side, and it continued to prove to be a thorn in the side because it came out with not a blockbuster number, but the markets were expecting 130,000 jobs being created, and it came in at 177,000 for the month of April. Now, I include there in the note, the employment gains in February and March were revised lower by a combined 58,000. Remember, this has been the theme of the BLS jobs report. These numbers come out and they are always revised and have been revised, majorly revised backwards and negative. Problem is, they come out, markets trade on the headline number. This makes when you beat the market expectations, it sounds like the economy's humming right along and there's no blips on the radar. And that's the case with a lot of this hard data. Unemployment remained at 4.2%, and average weekly earnings were up 0.2% for the month over month and 4% year over year. A lot of again, I use the term, hard data. Is there soft data, Mike? Yes. There's soft data in surveys like the Consumer Sentiment Survey, which is pretty much nosediving. Even the own interior divisions of the Fed have their reports. The Philly Fed Index is due out this week. It might even be as early as tomorrow. They've been negative on their economic outlook. The Fed's own what they call the Beige Book is technically showing the economy in a worse place than it was last September. And remember, last September is when they had to do their kind of jumbo cut, and they cut the federal funds rate by 0.5% because they didn't do a quarter in July. So it's kind of rinse and repeat, depending on the economist you listen to, that the Fed uses this hard data that we have here on the slide, but you have to remember that this is always data that's looking in the rearview mirror. In the here and now soft survey data, consumer sentiment, the individual Fed districts and their reports on economic findings there's a huge disconnect. And the Fed at their meeting last week when they held rates steady, a lot of economists believe that they're once again they're low, they're late to the game, right? And then we probably should be seeing, should have had a 0.25%. But when that jobs number comes out, 5 days before their meeting, they seem to be a Fed that, and this is historically what the Fed does, is they hang their hat on this hard data. And when the soft survey data that's out there and existing, that's capturing the here and now, a lot of it is like the rents. We've talked about shelter component. We'll look at CPI here in a second, where real-time rents are coming down, but there's such a lag effect in this hard data. And it hasn't caught up. Just yesterday, we got consumer price index inflation reading. This measures the inflation on the consumer level, was reported at 0.2%, what was below expectations of 0.3, decreased by 0.1 to 2.3 year over year, which was lower than the estimated 2.4. Again, favorable bond-friendly news, right? It didn't show an uptick in inflation in the core. Again, when you strip out energy, just like on the PCE, that increased 0.2 for April, which was below the expectations of 0.3 and stayed level at 2.8 year over year, which was in line with the expectations of 2.8. So no real harm done there with yesterday's report. And again, we'll get retail sales. Not to sound super negative, but I think retail sales tomorrow, along with the producer price index, which is inflation data on the wholesale side, I think we'll see some inflation fears reflected in those numbers. I think we're going to see potentially a stronger than expected retail sales. And the reason for that, if you've listened to any economists, they're expecting the same thing. And that's the mindset of the consumer that, okay, with all this tariff stuff, I'm going to go buy that car now. I'm going to go buy that big purchase now, whatever it might be, because they're trying to get ahead of and not be impacted potentially by, tariffs increasing the price of those goods later on down the road. So whether it's, pre-planned or even impulse buying to proactively avoid tariff increases, I think we're going to see a stronger than expected retail sales. And if the markets react like they typically do, and I think we got another rough week for mortgage rates because these reports are going to come in a little bit stronger. But again, like I said, this stuff isn't in a straight line. We still have a lot of stuff coming down the pike here to get sorted out. All right, so that's CPI. We usually look at this chart. We know shelter is a huge component. Shelter, 44.3% of the core model. And that's made up of rent, owner's equivalent rent, and lodging away from home. Now, rents were up 0.3. Owner's equivalent rent was the big dagger. It was 0.44 last month. It was 0.4. And remember, that's a survey, and imputated data where homeowners are called and surveyed and asked the question, if you were going to rent your house, what amount of rent do you think you get for your house on a monthly basis? And you have to consider that the average consumer homeowner who doesn't work in mortgage and real estate like we do probably doesn't have a realistic idea. So they're just spitballing numbers out there. So that's a tough one. Lodging away from home is your Airbnb and hotels. This one's always the wild card. A lot of this is seasonal, months with holidays and travel and hotel bookings, summer months, right? Right now, this number is down 0.1%. And didn't cause too much of a problem. Airline fees and the used autos were down again, but keep in mind this is April's number. We got to see what these retail sales look like. Were people out buying used cars and trucks? Motor vehicle insurance has been a thorn in the side. Not a great reading there, but again, when you look at everything else core at 0.12, I mean, it's the shelter stuff that's continuing to kind of drag. And again, it's got that lag component to it. Although there is talks, where rents seasonally are typically, we might see a little spike. But again, that won't be reflected in this. That'll be more of real-time data that will come out in reports, and a lot of these sometimes are the reports that we're talking about that the Fed has access to all this. They've got to be looking at it, or at least we hope they're looking at it. They seem to be doing a pretty good job publicly of, for lack of better terms, ignoring it. So when you take out the shelter lag, core PCE is at 2.3 and not 2.8, right? So there's about 0.5% in the inflation reading just on the shelter component, which rent is lagging. Owner's equivalent rent is kind of a, hey, what do you think you can rent your house for? It's people's made up numbers potentially, or numbers, let's say that may not be solidified with research and data, and then lodging away from home, which is always up and down. All right, local market. We're a little bit earlier in this month's report, so Northern Virginia and Prince William area are April report numbers. The Dulles area, those are still March numbers, but Northern Virginia is median price $779. That's up 3.7 year over year. Now total sales were down in April, 2.4%. Prince William median price was $574,990. Sales were up 2.7% year over year, and total sales were up 9.7% year over year. It was just last month that Prince William region was negative in sales, total sales year over year, and in the Northern Virginia region was in the positive territory. So we're going to see some of those fluctuations, and arguably we have a bit of a slower market building inventory, although could be arguable depending on where you do most of your business. So it'll be interesting to see how these numbers progress in the coming months. All right, lending information. I had this on last month. I keep it on this month because the date is still forthcoming. Government loan products, FHA and USDA rural housing. On May 25th, they are eliminating the eligibility for non-permanent resident borrowers to utilize FHA and USDA rural housing financing. Now, that is who is still eligible? It's basically U.S. citizens and then green card holders, right? Your non-permanent resident borrowers are the ones that are here, legally here, but only on work permit status. That's the population that FHA and USDA are eliminating from eligibility. You know, and that's when you think locally, but then also on a national level, right? That is now taking financing, favorable financing too, at that, or arguably favorable financing, right? FHA's known for flexibility of credit underwriting, accepting lower credit scores, being a little more lenient on debt ratio, things of that nature. That serves, you know, non-permanent resident population well. And now they're basically taking that away. You know, so the borrowers, you know, these non-permanent resident work permit holder borrowers, you know, are going to have to potentially now look at non-QM and portfolio type of products. And there are plenty of them out there. The downside is that they're just not as attractive and not always as flexible from an underwriting perspective as, let's say, the government loan products. So it'd be interesting to see what, you know, how does that impact the market, right? It's not technically in effect yet. But I know companies like ours have already kind of set an internal company date where, you know, we want to make sure we have case numbers well in advance for any non-permanent resident borrower, so that we can ensure that we can, you know, that they're in process right now and under contract, that we're closing them with a case number dated before FHA's May 25th deadline. Virginia Housing just came out and announced a new program called First Home Dream Program. And what this is, it's a 2% reduction in mortgage rate. It must be a first-time home buyer. And if there's a spouse, must also be a first-time home buyer, even if they are not on the loan, and excluding air property, and we'll get to that in a second. But the main crux of this is the parents or legal guardians of these first-time home buyers cannot have owned a home in the past 3 years as well. So it's a first home buyer generation program. Essentially, right? And you can only do this on the bond programs across conventional FHA, VA, or rural housing through Virginia Housing. Obviously, since it's Virginia Housing, the property must be in Virginia. It can be combined with the grant program and the plus second mortgage program. However, the sponsor organizations that get these funds, you know, it's like Federal Home Loan Bank funds, it's like Spark funds, right? It's a first come, first serve. It's not a never ending supply. So you have to remember that there will be, you know, susceptibility to availability of the funds by the sponsor organizations. And this cannot be used for those of you that are thinking, hey, I know Spark funds are out there in certain areas and they're used to reduce the interest rate 1%. Can I do Spark and First Dream and get a 3% reduction in interest rate? The answer is no. They are not permitting that. But essentially, first generation buyers, there's a whole new slew of affidavits that will need to be signed by the borrowers, attesting to that their parents have not had home ownership in the previous 3 years. You know, so there's a little bit more paperwork involved, but for anybody who fits into the box, and I say this of all, you know, Virginia housing programs, like if you're fitting into the box, household income limits and all, and now you can check this box as a first generation buyer. This could be a very, very positively impactful program to serve our borrowers. And this little grid here, now I know it's a $235,000 loan amount example, but when you look at, hey, you're doing the regular program and that interest rate's, you know, it's 7 in this current market. If you're that same buyer that fits into the First Dream, you can get the mortgage for 5%. Look at that, the savings is $302 a month, or $36.23 a year, or over the course of a 30-year loan, $108,700 $695 in savings. So could prove pretty impactful. And again, this is merely an example. Obviously, I know many of us are in higher price points. Some of us might be in lower price points, but this serves as merely an example just to give you the idea that you save 2% on an interest rate, regardless of what your mortgage, what the loan amount itself is. It's a pretty significant savings, to say the least.
Mike,
Yeah,
so with this program, they only need that 3% minimum with the FHA?
3.5 minimum percent.
3.5, I'm sorry, yeah.
Yeah.
And if they have some money, like a gift from the parents, can they use that?
If gift money is acceptable, yeah, if the scenario involves gift money, the caveat with FHA is have to be very careful that not all borrowers who can only do FHA, and especially when it's a single borrower on the loan and gift money is involved, and if the credit history is not great, that scenario doesn't always go through automated underwriting.
So it has to be more than 680 then to be safe.
Well, no, it's got to be at least 620 in minimum score, but there's no lender or Virginia Housing, right, can guarantee what the automated results of the underwriting systems are going to spit back out. I've had single borrower FHA, not so great credit history. Obviously, they're looking at it doing a minimum down, and if they try and do the grant, usually it's a problem with the grant program. If they're getting grant money and then gift money from family, there is something in that algorithm that the automated systems do not like that. We're seeing a workaround where they can do the plus mortgage and actually get the entire down payment in the form of a second mortgage, that when we rerun it that way, that same borrower, same credit history, and gift money, but with the second plus mortgage, then the system takes it. It's very bizarre, but yeah, I wouldn't want
But
I wouldn't want any of you to
it will be
believe
better
that.
to structure with conventional if they can
What's
get the 5% gift.
Yeah, that borrower profile and a single borrower is probably not going to go through conventional, even with 5% down.
Okay.
It usually takes a much bigger down payment, and most of the time we're drawing the line because our first time home buyers, the majority of them can't do 20% down. That's why we're looking at this program to begin with.
Okay.
But from an automated underwriting standpoint, I wouldn't want any of you to ever think that these programs are just a slam dunk, especially when it's one borrower. You add another borrower with the same marginal, questionable credit history, but a score that is above the minimum, that probably goes through with gift money. There's something that it does not like about one borrower, not so great credit, and then getting a grant and gift money.
Yeah. But it's like somebody already established a good job, and they've been in the job for 2 years, and they trying to wait for the curve in the market so they can actually buy something and take advantage of all of these advantages with Virginia cut in the rate.
Yeah, absolutely. Again, this is like hot off the press as of last week program. We'll be interested to see how much traction it gets. Again, Virginia Housing already has boxes you have to check, and now these are more boxes that they have to check, and the borrower's going to fit into it. And then a lot of the times, whether it's household income or and that's usually the main thing that kicks people out, or because Virginia Housing has a maximum debt ratio of 50% on all their programs. Sometimes debt ratio is, the kick out, or they make too much money, or the household makes too much money when they're trying to do the bond programs.
Yeah.
Keep in mind, Virginia Housing does have a non-bond expanded program, higher income limits, but the trade-off is a little bit higher rates. But you know, if it becomes the non-bond program becomes the only option for a first-time buyer, you know, my thought is at least it's better than no option at all to explore.
Yeah. Thank you, Mike.
Any questions, guys?
Thank you, Mike.
Hey, Alicia, thanks for being here. Yeah, guys, again, thanks for tuning in. As Cindy mentioned, we're doing a first-time homebuyer 2-hour credit.
That's right,
class.
with free credit.
Yeah. Servicing first-time homebuyers. We'll talk a little more nitty-gritty as we usually do in that 2-hour class about some more of the specifics surrounding the Virginia Housing First-Time Buyers
And that's
programs.
9:30 in the morning. So make
Yep.
sure you go to cindybishopworldwide.com to upcoming events. It'll be right in the immediate feed in front of you. All right. Thanks, Mike.
Yeah, thanks for coming, guys. Appreciate
This
it.
presentation later in a couple hours will be on Mike's instructor page, so keep that in mind. We update it every month. All right, guys. Have a good day. Thanks.
Thank you, Cindy. Thank you,
Yeah.
Mike.
Yeah, thank you, everybody.
Bye-bye.
Bye.